Welcome back after a holiday weekend. This is your Mortgage Rate Watch for Monday, December the 27th, and I'm Keith Akata with the Mortgage Reel. Let's take a quick look at the bond market page, and what's really happening this morning is it's relatively flat, and we're still trying to hold some of the great gains that we saw throughout the past couple of days last week and hanging on to that. But where the real news strikes is over the Christmas weekend. On Christmas Day, the People's Bank of China, in an effort to fight inflation, raised their index by 0.25%, and this is the second hike since October. We talked about this in past posts about what's going on with China and how it impacts the bond market. Now, there's not too much reaction right now, but keep in mind that Wall Street is relatively slow in trading because there's so many of the traders from the trading pit, investors, hedge fund managers, portfolio managers, all out on vacations right now, so it is a little bit thin. But the one thing it does pressure the United States bond market is the fact of the yields. Now, when we talked about yields before, again, a dollar invested, where are you going to spend your dollar? If you're going to put a dollar into the market and someone's paying 1% and you have someone on the other side of the river paying 2%, you're most likely to cross the river to invest with that 2% to get the greatest rate of return. Well, from that standpoint, China, again, that market could show that because of their interest rate hikes to control inflation, it's making their returns look better than the U.S. bond market, and it could mean that more funds from the U.S. get sent over to China. Not a definitive, but it is a possibility, and it does put pressure on mortgage rates if that should happen. Now, the one thing that we have to also remind is that right now the People's Bank of China, they're trying to control inflation, and with that, they have sent a clear message that they're going to do whatever it takes to control that, because it's risen at a 5.1% year-over-year pace. That is incredibly high compared to where the U.S. right now. Obviously, we're trying to control deflation, and the flip side of that is what the Federal Reserve is getting ready to do to create inflation. And by creating inflation, how they're doing that is QE1, quantitative easing 1, quantitative easing 2, pumping more money into the Wall Street market to get the Wall Street going and the S&P going. Right now, all the chatter on CNBC and all the media is right now is where the future of the S&P is. A lot of people see a 20% upward swing right now with the S&P 500 in 2011. And again, if that is coming to fruition, that is going to put a lot of pressure on the U.S. market, especially the bond markets, to show performance. And with the Federal Reserve, if they like they announced last week, the rumor is that they're going to potentially raise by 0.5% going into the new year by the end of 2011. So if they do raise by this 0.5%, we warned last week about the home equity line of credit, the adjustable rate mortgage, everything in play. So we just want to put that out there as a warning that this is not something that's reacting at the moment with rates, but it's going to have a huge impact as we move forward into 2011. Make sure to follow us on our Facebook fan page for breaking news and updated posts. We're getting ready to put a whole series out on homeowners education, which is going to be very exciting for us, and also our Twitter page for those of you who use Twitter. Other than that, we'll be back tomorrow with another post. Thanks.